when we're buying Tesla, it's a vertically integrated, company with all these increasing metrics. When we're buying, Ford or GM, it's like they've outsourced everything. It's almost like a brand and a financing operation. How much of even apples to apples comparison is Tesla to these other automakers in a lot of these metrics? Because a lot of people will say like the price sales ratio of other automakers, price earnings ratio is so much lower. But I have to think that's because the growth is so low, and maybe because under the hood, these financials aren't as good as they seem. So could you help me try and bridge that gap of why Tesla trades more like a high growth tech company, not an auto company, or that's kind of what has people so confused?
Yeah, so I think it's trading at a significant premium over the market, over the auto market, specifically because of these three things. We see, 50% revenue CAGR, right? No one has that in the auto industry. We're seeing, an inflection in free cash flow and a growth in free cash flow that exceeds everybody else. We're seeing competitive cash flow return on assets, as I just mentioned, and competitive cash flow return on equity. At the same time, the other part of it, right, is looking at the cost of capital, right? And that's another thing that's a little bit more, clandestine. It's a little bit less understood, right? What is the cost of capital? So a stock can go up because it has increasing free cash flow or increasing cash flow. A stock can also go up if their cost of capital is declining, right?
Basically, when they go to get a loan, how much are they being charged?
Right. Yeah. So overall, both debt and equity together is the cost of capital. So what can drive the cost of capital lower? One of that is leverage risk, right? And so that's why we have this next chart here that looks at Tesla's net debt. And we see that it hit a very high level of around, I think, Q2 of 2018, where their net debt was about 9.2 billion. And net debt is just taking total debt, right, minus their cash on the balance sheet. So if you look at that, it actually dropped from, a high of 9.2 billion. It kind of bounced back a little bit there over the next couple of quarters. It, went back up to 9.1 billion. But then what happened throughout 2019? It dropped significantly from 9.2 at the high to under 7. That's a 25% reduction in net debt. When net debt goes down, that means leverage risk is going down. And when leverage risk goes down, the cost of capital goes down. When cost of capital goes down, the equity and the bonds go up. So that's why we saw bonds. If you look at the price of Tesla's bonds and equity, both are going up, in my opinion, because we see that there's effective deleveraging happening in the balance sheet. So 25% reduction in their net debt. Now, some of that is due to equity, right? Due to their equity raise, right? So if Tesla goes to the capital markets again and does another $1 or 2 billion in equity, then of course their net debt is going to go down, right? But as we saw in the previous chart, they're free cash flow positive. And free cash flow has nothing to do with how much they're raising in debt or equity, right? That's the core cash collection from their core business operations, including all of their growth spending. So yeah, it went down, and part of it is due to the fact that they did raise equity, but it's not entirely due to that. So as long as free cash flow is positive, the net debt will continue to drop. And I believe as of, by the end of this year, we're going to see net debt, almost cut in half from 6.9 billion to about 3.8 billion by the end of this year. So I believe that's my personal estimate, considering the free cash flow of 1 billion, the 2.3 billion in equity raise that they did, on top of the 6.3 billion in cash exiting Q4 of last year.
Yeah, and you're not even adjusting this net debt position for the size of the business, which is getting way bigger as well. So I feel like that's another factor at play that makes that kind of, basically de facto reduces the debt without reducing it, just because the assets are getting bigger. But
yeah, And that's why I have this next chart here, which looks at the net debt relative to that adjusted EBITDA number. And this is a metric used by a lot of folks to measure the effective leverage of a company. So we saw that it hit a very high level of, Q3 of 2018. So net debt relative to their EBITDA was, almost 14 times, which is very high, right? So there was a major risk, and a lot of, short sellers were right to point out that they are, heavily leveraged. So if revenue, or if something were to happen to their revenues, or something were to happen to their cash flow, they would be in trouble, right, with that high of a leverage ratio. But we saw, through 2019, that number dropped precipitously, from a high of about, 14 times down to 2.2 times as of Q4 of last year. And my prediction is that it's going to drop below 2 by the end of this year. Or sorry, below 1 by the end of this year. So
Wow.
that, and just to put that into context, investment grade companies, so I'm talking about like the Apples and Amazons of the world. Their average net debt to EBITDA is roughly 1, or maybe about, it ranges from between like 0.5 to 1. So I believe Tesla's net debt to EBITDA, and this sounds super crazy, I know how crazy it does sound, but I think that by the end of this year, we're going to see Tesla's net debt to adjusted EBITDA in line with investment grade companies. So the highest credit quality companies out there, Tesla's going to be competitive with them on a leverage ratio, on this particular leverage ratio.